In 1997, 7 countries collapsed in a single summer. Not slowly, not gradually. Overnight. $2 trillion in wealth vanished from the global economy. Families lost their life savings in 72 hours. Governments that had stood for decades fell apart. And one man made $1 billion while it happened. His name was George Soros. And he didn't hack a system, forge documents, or bribe a single official. He simply saw a door that governments had left wide open. Then he walked right through it. Here's the part that nobody talks about. 7 central banks tried to stop him and lost. Every single one. So how does one hedge fund manager bankrupt an entire region? And why did the smartest economist on earth never see it coming? That answer starts not in 1997. It starts in the wreckage of World War II, and a backroom deal that shaped the entire global financial system. To understand 1997, you need to understand one rule that governed global money for decades. After World War II, the world was in ruins. Governments needed stability. So in 1944, 44 nations met in Bretton Woods, New Hampshire. They made a decision that shaped everything that followed. Every currency in the world would be pegged to the US dollar. The dollar itself was backed by gold. Simple, stable, safe. But in 1971, President Nixon broke that deal. He took the dollar off the gold standard entirely. Suddenly, currencies were worth whatever the market believed they were worth. Nothing more, nothing less. This created a new world, one with a fatal vulnerability. And by the 1980s, a group of Southeast Asian nations had found it. Thailand, Indonesia, Malaysia, South Korea. They were growing fast, faster than anywhere else on Earth. Annual growth rates of 8, 9, even 10%. Western investors were pouring money in. The World Bank called it the Asian miracle. Time magazine ran cover stories on the Asian tiger economies. But underneath the growth was a dangerous bet. These governments had pegged their currencies to the US dollar, the Thai baht, the Indonesian rupiah, the Malaysian ringgit, all artificially tied to the dollar's value. This made foreign investors feel safe. They knew exactly what their money was worth. So they poured in billions, fast money, looking for fast returns. But here's the problem with a currency peg. It only works if you can defend it. To defend a peg, you need foreign currency reserves. Specifically, you need US dollars in the vault. When your currency comes under pressure, you buy it back with those dollars. That's how you hold the line. Thailand's government believed their reserves were untouchable. They were wrong. George Soros had been watching Southeast Asia for years. His fund, Quantum Fund, was one of the most powerful on Earth. He employed some of the sharpest macroeconomists alive. And in early 1997, his analysts ran the numbers on Thailand. What they found was alarming. Thailand's banks had borrowed massively in US dollars. They had loaned that money out in Thai baht. But the baht loans were going into risky real estate and bad projects. The assets were rotten, the debt was real, and the peg was the only thing holding it together. Here's how the trade works, and this is important. Soros didn't buy Thai baht. He borrowed it. He went to banks and said, "Lend me billions of baht." The banks agreed. They were earning interest. Then Soros immediately sold all that baht for US dollars. Now he held dollars, and he owed baht. He was betting the baht would collapse. If the baht fell in value, he could buy it back cheap, pay back the loan, and keep the difference. Think of it like borrowing your neighbor's car, selling it for $20,000, then buying it back for $8,000 when its value crashed, and handing it back, and pocketing $12,000. That's a currency short, and Soros did it at scale the world had never seen. The question was, could Thailand defend the peg? Their central bank tried. They spent billions of dollars buying baht to prop up the price. They raised interest rates to make baht more attractive to hold. They begged foreign investors not to panic. But there was one problem they couldn't solve. Their dollar reserves were running out. And Soros wasn't the only one selling. Once word spread that the baht was under attack, other funds piled in. hundreds of traders smelled blood. The Thai central bank was now fighting an army, and they had already spent $33 billion they didn't publicly admit to having. There was one internal memo, written by a Thai finance ministry official in March 1997. It said, and this is chilling, "We cannot hold this position indefinitely." That memo never went public. The government kept reassuring citizens everything was fine. But behind closed doors, they knew. The bot was already dead. They just hadn't told anyone yet. To understand what was about to be destroyed, you need to see what Asia had built. Because in the early 1990s, Southeast Asia wasn't just growing. It was the envy of the entire world. Bangkok had transformed into a skyline of glass and steel. New skyscrapers were going up faster than any city in history. Jakarta was being called the next Singapore. Seoul had one of the fastest growing middle classes on the planet. Between 1985 and 1995, the Asian tiger economies grew by an average of 9% per year. For context, America was growing at 3%. Millions of people who had lived in poverty just one generation earlier were buying homes, sending kids to university, building businesses. This wasn't just an economic story. It was a human story. Decades of hard work were finally paying off, and Western money was flowing in to claim its share. American pension funds, European investment banks, Japanese conglomerates. Everyone wanted a piece of the miracle. Between 1990 and 1997, foreign capital flowing into Southeast Asia tripled. $300 billion poured into the region in less than a decade, and the governments loved it. Prime ministers gave speeches at Davos about the Asian century. Malaysia's Mahathir Mohamad said Asia would lead the world by 2020. The IMF published glowing reports about sustainable growth. Wall Street analysts called Thailand's economy fundamentally sound as late as 1996. Nobody wanted to say the quiet part out loud. The miracle had a dark engine underneath it. Thailand's banks weren't lending carefully. They were lending recklessly. Half-finished office towers sat empty across Bangkok. Developers had borrowed billions assuming prices would rise forever. Golf courses were being built in the middle of nowhere. Luxury condos nobody could afford sat vacant for years. But because the baht was pegged to the dollar, nobody panicked. The numbers looked fine on paper. Foreign investors kept arriving. Credit kept flowing. And at the very top, the lifestyle was extraordinary. Thai bank executives flew private. Indonesian tycoons bought estates in London and Beverly Hills. South Korean conglomerates, the Chaebols, were expanding into every industry imaginable. Cars, ships, semiconductors, hotels, insurance, fast food. Samsung alone had subsidiaries in 25 countries. These weren't just companies, they were empires, and they were all built on borrowed dollars. Meanwhile in New York, George Soros was not impressed. His team had run the numbers over and over. The math didn't work. The assets backing these loans were overvalued. The reserves defending the currency pegs were quietly shrinking, and the hot money that had flowed in could flow out just as fast. In fact, faster, because of the internet. This is a detail most documentaries skip over. 1997 was the first financial crisis of the digital age. For the first time in history, capital could move across borders in seconds. A fund manager in London could sell Thai assets from his desk before lunch. The speed of modern finance had outpaced the speed of government response, and nobody had fully understood that yet. Nobody except people like Soros. He saw a system that was built for a slower world, now running at a speed it was never designed to handle. There was a moment in early 1997 that captures everything. Thailand's finance minister gave a press conference. He stood at a podium, smiled, spoke confidently. He said Thailand's fundamentals were strong. He said the baht was safe. He said investors had nothing to fear. Cameras flashed, reporters nodded. And behind him, the central bank had already spent $23 billion defending the peg. In secret, the minister knew. The central bank knew. The prime minister knew. But the people whose savings were tied to the system, they had no idea. 40 million Thai citizens went to sleep that night believing their money was safe. It wasn't. And in the trading rooms of New York, London, and Hong Kong, the attack was already underway. Quantum Fund was not alone anymore. Tiger Management, Tudor Investment, dozens of smaller funds, all of them had run the same analysis. All of them had reached the same conclusion. The bot was going to fall. The only question was when, and that question was about to be answered. Because on the morning of July 2nd, 1997, the Thai government made an announcement. 3 sentences that detonated the entire region. July 2nd, 1997, Bangkok, 7 a.m. local time. Thailand's central bank issued a single statement. The bot peg was being abandoned, effective immediately. That was it. 3 sentences, no warning, no plan. Within minutes, the bot lost 15% of its value. By end of day, it had fallen 20%. 40 years of carefully managed exchange rate gone before lunch. Foreign investors didn't wait to see what happened next. They ran. Capital that had taken years to flow into Thailand left in hours. Billions of dollars moved out of Thai accounts before the markets closed. And then something nobody fully predicted happened. The panic didn't stop at Thailand's border. It jumped. Investors looked at Malaysia, Indonesia, South Korea, the Philippines. They asked one question: are they the same? The answer in their minds was yes. Within days, the Malaysian ringgit was under attack. Within weeks, the Indonesian rupiah was in free fall. Within months, South Korea, the 11th largest economy on Earth, was begging the IMF for help. This is what economists call contagion. One infected node spreading to the entire network. But this wasn't a metaphor. This was 600 million people's lives. In Indonesia, the rupiah lost 80% of its value in 6 months. Read that again. 80%. A family that had saved the equivalent of $10,000 now had $2,000. Not because they did anything wrong. Not because their business failed. Because currency traders in New York decided to sell. Grocery prices doubled overnight, then doubled again. Riots broke out in Jakarta. Supermarkets were looted. 30 years of economic development erased in a single quarter. Indonesian President Suharto, who had ruled for 32 years, was forced to resign. A government fell because of a currency trade. In South Korea, the crisis hit differently but just as hard. The chaebols, those massive conglomerates, started collapsing. Kia Motors went bankrupt. Daewoo, one of the largest companies in Asia, began unraveling. Unemployment doubled in 6 months. South Korean citizens did something remarkable and heartbreaking. They lined up voluntarily to donate their gold jewelry to the government. Wedding rings, necklaces, family heirlooms, to help pay off national debt. 3 million people donated gold in a single national campaign. Let that image sit with you for a moment. Meanwhile, the IMF arrived with a rescue package. $40 billion for South Korea, $43 billion for Indonesia, billions more for Thailand. But the money came with brutal conditions. Cut government spending, raise interest rates, close failing banks. Austerity, immediately. Economists still argue about whether those conditions made things worse. Because raising interest rates during a collapse crushes businesses that need cheap credit to survive. Thousands of small companies that might have recovered were pushed into bankruptcy instead. The cure, some argued, was killing the patient. Back in New York, Quantum Fund was counting its winnings. Soros's fund made an estimated $1 billion from the back collapse alone. His total gains across the Asian crisis, some analysts estimate $2 billion. He gave interviews. He said he was simply responding to market conditions. He said governments created the vulnerability, not him. He said if the peg was indefensible, it would have fallen eventually anyway. He wasn't entirely wrong, but that didn't make it easier to hear. Malaysia's Prime Minister Mahathir Mohamad went further. He called Soros a criminal in a live speech at the United Nations. He called currency speculation morally indefensible. imposed capital controls, making it illegal to move money out of Malaysia without government approval. Mainstream economists were horrified. The textbook said capital controls always make things worse, but Malaysia recovered faster than any of its neighbors. Economists are still arguing about that outcome today. And then, quietly, buried in the rubble, investigators found something disturbing. Thailand's central bank had been hiding the true state of its reserves for months. Not miscalculating, hiding. They had made secret forward contracts, promises to pay dollars in the future, that didn't appear in official figures. So when Thailand reported $30 billion in reserves, the real available amount was closer to $7 billion. The government had lied to its own people, and to the international community, and to the investors whose money they were burning through. The bat was never defensible. Everyone in power knew it, and nobody said a word. When the dust settled, the numbers were staggering. $2 trillion in wealth, gone. Not transferred, not hidden offshore, gone. Erased from balance sheets, retirement accounts, and family savings across 7 nations. The World Bank estimated 24 million people fell back into poverty, people who had spent decades climbing out. In Thailand, the suicide rate spiked 40% in 1998. Not a statistic, 40% more families destroyed. In Indonesia, child malnutrition rates climbed for the first time in 30 years. A generation of progress reversed in 18 months. And accountability? Almost none. No Thai banking official went to prison for hiding reserve figures. No fund manager faced criminal charges for the short-selling campaign. George Soros paid no fines, faced no trial. Under the laws of 1997, everything Quantum Fund did was completely legal. That's the part that should make you angry, because it forced the world to ask a question it had been avoiding. Should it be legal to short-sell an entire country's currency? The debate exploded in academic circles, government halls, and trading floors. Malaysia said no and imposed capital controls. Most Western economists said yes and argued markets must remain free. The IMF, humbled by its handling of the crisis, began a decade-long internal review. They quietly admitted their austerity conditions had been too harsh, too fast. That acknowledgement took 11 years to arrive. For the families who lost everything, it arrived too late. Real change came slowly. Asian governments collectively made one decision after 1997. Never again. They began stockpiling US dollar reserves at historic levels. China alone built reserves exceeding $3 trillion over the following decade. Not for growth, not for investment. As a shield. A fortress against ever being exposed like Thailand had been. The architecture of the entire global financial system shifted, partly because of one summer in 1997. And here's the lesson that never makes the headlines. The Asian financial crisis wasn't caused by greed alone. It was caused by a system that rewarded speed over stability, that valued the free movement of capital over the protection of ordinary people. George Soros found a door that governments built and left unlocked. He walked through it, and 24 million people paid the price. The question the world still hasn't fully answered is this: when the rules allow something that causes that level of human destruction, are the rules the problem, or the people who exploit them? 7 nations collapsed in a single summer. Millions fell into poverty overnight, and not one person went to prison. That's not just a financial story. That's a story about who the system was built to protect, and who it was built to sacrifice.